What if I told you the biggest secret to one of the most successful hedge funds ever was built on a strategy so basic your grandmother could run it? And what if I told you that I found a way to triple that fund's returns without jacking up the risk? You better stick around because today I'm going to show you exactly how this is done. Hey folks, Porter here. If you've been with me for long, you know I've always got my eye on investment strategies that actually work through bull markets, through bear markets, and through whatever the Fed tries to throw at us. So today I'm going to walk you through a revamped version of a classic portfolio strategy that hasn't just beat the market, it demolishes it. But best of all, you can greatly increase your returns by tweaking this portfolio just a little bit. And you don't have to touch leverage or crank up the risk profile at all. I know that sounds impossible, so let me show you how to do it. Before we do, please do yourself a favor, hit that like button and subscribe if you're serious about actually protecting and growing your wealth. And if you haven't signed up for it yet, get my free daily newsletter, Porter's Daily Journal. You'll get a whole bunch of strategies that can save you from the next financial train wreck. The link is in the description. Now don't wait. Okay, let's talk about a strategy that's been hiding in plain sight for decades. This is the brainchild of a man named Harry Browne. Harry Browne wasn't just an investor. He was a contrarian philosopher who saw the writing on the wall about our economy today. His permanent portfolio was an idea that's stunningly simple and yet can protect you against the inevitable inflation of our paper money economy. Here's how it works. You put 25% in stocks, that's for growth. You put 25% in bonds, and that, of course, is to hedge your position in stocks. But then you put 25% in gold, that's to hedge your bonds from inflation. And finally, you put 25% in cash to damp down the volatility on the portfolio. And this 1/4, 1/4, 1/4, and 1/4 allocation can handle anything the economy is going to throw at it. Recessions, bonds do great. Inflation, the gold does great. Crashes, you've got cash to buy stocks at the bottom. For years, this strategy has quietly compounded some of the wealthiest families' money in America at about 7% annually, with barely a ripple of volatility. Now, Harry Browne started that permanent portfolio back in the 1970s. And then, fast forward a few years, in the late 1980s, along comes Ray Dalio. And Ray, as you probably know, is the guy behind the world's largest hedge fund, Bridgewater Associates. Now, Dalio didn't go reinvent the wheel. He was looking for a super low volatility portfolio. So he borrowed Harry Browne's playbook and he created his version of the permanent portfolio, which he called the all-weather portfolio. He didn't really change it very much. He just tweaked the allocation a little bit. He actually ended up putting more in bonds. Why would he do that? Dalio's secret weapon was leverage. Dalio knew that if he started with a super low volatility portfolio, he could leverage the portfolio up to boost returns while keeping risk under control. And that is the strategy that's behind his Pure Alpha Fund, which is one of the most successful hedge funds in history. But here's the kicker. You don't actually need leverage to beat Harry Browne's returns. I'm going to show you how to about triple the performance of the permanent portfolio using just 4 low-cost ETFs. There's no leverage, there's no hedge fund manager, and there's not much additional risk at all. This is just a smarter, modern version of the permanent portfolio. So how do we upgrade Harry's classic mix? Well, it's easy. Instead of just buying the S&P 500, all we have to do is focus on higher quality businesses within that index to get better returns. Think about stocks like Apple and Microsoft and Nvidia, the types of companies that continue to make money even when the rest of the world declines. The easiest way to get exposure to the highest quality companies? Just use the iShares MSCI USA Quality Factor ETF. This fund zeroes in on only the top quality companies that consistently deliver superior returns, and they have far outpaced the S&P 500 historically. Okay, and number 2, bonds. This is where I think most people have screwed up the most. Bonds, as I'm sure you've seen, have been decimated by inflation. So why stick with a losing hand? Instead of buying government bonds, swap out traditional bonds for something smarter, like property and casualty insurance companies. Now, let me explain what I mean by that. What you have to know is that a property and casualty insurance company is really just a giant pile of bonds with an active manager on top and, of course, an underwriting department. So these firms make money through underwriting, and then they invest that money in those bonds. But they manage those bonds according to what they see in the markets. This active management will allow property and casualty insurance companies to blow a traditional bond fund out of the water. And you can access these kind of companies through an ETF, like the Invesco KBW Property and Casualty Insurance ETF. These kind of insurance companies offer bond-like stability, but with far better returns and less volatility. That's a big win. Next, let's talk about the importance of gold in this strategy. You got to have gold so you make sure that you're hedged against inflation. And back in Harry Browne's day in the 1970s, gold was the ultimate hedge. It was the firewall that every investor needed against inflation and against government monetary abuse, especially in the 1970s. But today, there's a new player in town, Bitcoin. That's digital gold. And if you're serious about protecting yourself from the crumbling facade of fiat currencies, you need both gold and Bitcoin in your portfolio. So let's split your allocation between gold. You can buy gold through an ETF, GLD, and let's include Bitcoin. That way you can cover all the bases. Gold is going to shield you from inflation, while Bitcoin's decentralized nature guards against currency devaluation and the deep state's grip on the banking system. Let's be honest, Bitcoin isn't going anywhere. It's here to stay. So let's include it in the portfolio. And today, with Bitcoin ETFs, it's never been easier to invest in Bitcoin. I recommend the low-fee Franklin Templeton Digital Holdings Trust, EZBC. And that's how you can add Bitcoin to your portfolio. So you've got gold and you've got Bitcoin, now you're hedged against inflation. Finally, the last part, and this is a part a lot of investors skip. Harry Browne knew the value of holding cash, especially when the markets are volatile. When the market takes a nosedive, you've got cash to buy securities at the bottom. So Harry recommended keeping 25% of his portfolio in cash to cushion against crashes. And I think we can take this one step further. Instead of just sitting on cash in the bank, I recommend using the U.S. Short-Term Note ETF. The symbol is SHY. This allows you to maintain liquidity while earning a modest return. I think your yields there right now will be close to 4%. Plus, you can also think about learning how to adjust your cash allocation dynamically. You'd want to hold more cash when the stock market is very overvalued, and then you want to cut that cash percentage during bear markets when you can scoop up super high quality stocks on the cheap. So let's talk about results. Harry Browne's original permanent portfolio did deliver rock solid, very low risk returns. But with these tweaks, with stocks that are focused on quality, with smarter bonds, and with the addition of Bitcoin, you're looking at a strategy that doesn't just hold up in rough times, it crushes it. And here's where things get really interesting. By upgrading the equity allocation, by swapping out bonds for high quality property and casualty insurance companies, by diversifying with both gold and Bitcoin, and by actively managing your cash position, you could have averaged about 13% a year annually for the past decade. That's double what Harry Browne's original strategy delivered, and that's without taking on any additional risk from leverage. If you're the type who wants to push the envelope a little further, there is one more twist. If you can stomach the extra volatility, you can actually get rid of the entire cash allocation and instead put all of that money into more P&C insurance exposure. Doing this could supercharge your returns to over 20% a year. And again, that entire portfolio is going to have less volatility in the stock market itself. So market beating returns with less risk. Imagine pulling off returns like that all by yourself. You don't need a hedge fund manager. You don't need anybody. You can just use ETFs. And that's going to protect you from inflation. It's going to protect you from higher interest rates. It's going to protect you from all the nonsense that the Fed keeps throwing at us. This portfolio is as simple and as low cost and as effective as it gets. And here's the funny part. Even though you're watching this video and even though you know that everything I've said is completely correct, you probably won't do it. Like I always say, horse meat water. You can show people the path, but only the smart ones are going to get on it. However, if you're one of those people and you're ready to get serious about protecting and growing your wealth, now's the time to act. Start building this portfolio today and watch how it performs in every market, up, down, or sideways. And don't forget to hit that subscribe button for more game-changing strategies just like these. Also, sign up for my free daily e-letter, Porter's Daily Journal. You'll get more insights like this delivered directly to you every day of the week. The link is in the description below. Join us and take control of your financial future. It's not even hard. Thanks for watching. And until next time, I'm Porter Stansberry, helping you build a smarter, safer portfolio for whatever comes next.
There's a reason why the world's best informed investors read my daily journal. Subscribe for free at portersjournal.com.